Brussels 5.85. In Madrid, also down 81.40. In Zurich, 59.26. In Moscow, the much maligned markets there, they were at 3.15. In Johannesburg, they were also down, or were down, I should say, 294.82. In Bombay, 117.94. In Karachi, they were in the negative at 53.89. In Lahore, 13.82. In Colombo, 21.80. And in Tehran on Wednesday, 215.40. In Sydney on Friday, 37.50. The Nikkei was at 162.68. Hang Seng in Hong Kong was at 535.73. And in Shanghai, they were down on Friday at 69.62. In New York, 20.32 on Friday. The Nikkei, which is stock-laden, was down 2.50. The Merck, the commodities market out in the Midwest city of Chicago, at 1.63. In San Pablo, 592.06. And in Mexico, 61.34. Let's quickly get the commodities in here. The Brent crude was up on Friday 24 cents at $66.94. We really do not like to see this. The spot was down $1.05 at $65.84. West Texas crude was down 12 cents at $59.89. T-Boone Pickett is jumping for joy. He remembers literally $15 a barrel oil. Gold on the Forex was up $1.55 at $1,216.30. Dubai gold futures, these are all there, was up $6.50 at $1,220.80. So some of the futures here, coffee was up $1.55. Cocoa was up $45. Cotton 31 cents. Sounds like we're in an apparel store. Corn futures were down $2.50. This is from the CBOT futures. And soybean futures were down $3.75. We follow these along here. And the Euronext future there. Cocoa was up $19. We won't get into the rest of those. We're on to Mr. Carney. And the chair of the UK Bank, that's Mark Carney. He used to be the Bank of England, I'm sorry. He used to be at the Bank of Canada. Nonetheless, this will do it for us. For those in business, make it a productive one. For the consumer, keep your eye on the ball. Consumers, of course, looking forward to more deflationary prices. Energy prices are going up, petrol in particular. Short term, we'll be watching very carefully to see where this goes in the summer driving season. We're in May now. We are beginning to, as they say, tip into summer, at least in North America here, and we'll be looking to that. We'll talk to you next week. Have a good weekend, everyone. On to the Bank of England's Mr. Carney.
Well, sometimes some predictions do come true. For example, as the MPC had predicted 3 months ago, I've had to write today the second in what's likely to be a sequence of open letters to the Chancellor. And that's because, as you know, as expected, inflation fell to 0 in March, 2 percentage points below target and the lowest since official CPI data began. As was the case in February, the single most important reason for below target inflation has been the sharp fall in energy prices. In March, oil was about 40% cheaper than the middle of last year, and the price of petrol at the pump was down by more than a tenth. Food prices have also dropped, and sterling's appreciation over the past 2 years has continued to depress import prices. Taken together, these factors explain about 3/4 of the shortfall of inflation from target, with the remainder reflecting subdued growth in domestic costs, particularly wages. The MPC expects that the past falls in commodity prices to be relatively short-lived and will therefore look through them in setting policy. Although it could temporarily turn negative in the near term, inflation is expected to pick up notably towards the end of the year as past falls in prices drop out of the annual comparison. Recent developments support the MPC's view that a temporary period of falling prices, driven by a few components of the CPI, should not be mistaken for the potentially damaging process of widespread and persistent deflation. The proportion of the CPI's components showing positive inflation is much the same as it was in the decade prior to the crisis. More fundamentally, the economy is growing, unemployment is falling, earnings growth is improving, and there is no evidence that household spending is being delayed. Given that inflation expectations remain broadly consistent with the 2% target, the more enduring influences on UK inflation will be the evolution of domestic costs, particularly wages relative to productivity, and the likely persistent drag from the strength of sterling, which has risen around 6% in the past year and 18% since its trough. These influences are currently weighing on core inflation, which fell to 1% in March and is expected to remain subdued for most of the year. The MPC's strategy for returning inflation to target remains the same as in February, namely to set policy to support the rise in domestic costs needed to return inflation to target within 2 years. The appropriate path for bank rate will hinge crucially on the outlook for supply, and that composition of supply growth is expected to shift notably over the forecast horizon as slack in the labor market is eliminated and productivity finally begins to pick up. After a comprehensive review, the MPC judges that the current slack in the economy is around 0.5% of GDP. The MPC expects that that remaining spare capacity will be absorbed within the next year. In recent years, labor supply has expanded significantly owing to higher participation rates amongst older workers, a greater willingness to work longer hours, and strong population growth, partly driven by higher net migration. These positive labor supply shocks have contained wage growth in the face of robust employment growth. Wages have grown by around 2% in the past year, less than half the average rate before the global financial crisis. And a key risk is that these subdued growth rates in wages continue for longer than we expect. Such strong growth in labor supply is unlikely to be sustained. Going forward, growth in the UK economy's potential will increasingly depend on productivity. In the medium term, productivity growth, doing more with less, is the key determinant of income growth, and our shared prosperity depends on it. Productivity, though, is not something that monetary policy determines, and among the many uncertainties we face, the timing and extent of any prospective pickup in productivity growth remains our most difficult judgment. One insight from our review of supply is that over the past year, some of the weakness in measured productivity reflects so-called compositional effects. In other words, there have been a disproportionate growth in relatively low productivity jobs, partly reversing what occurred when unemployment rose sharply. But there's also been underlying weakness, and in light of that, we've become even more conservative in our forecast for renewed productivity growth. In particular, productivity is projected to grow only modestly in the year ahead before returning towards but remaining below past average growth rates. That recovery reflects a number of factors, including the lessening of those compositional effects, a pickup in the reallocation of resources to new and more dynamic firms, and the effects of the investment recovery coming through. On the demand side, the expansion is set to re-accelerate following a slightly softer than expected first quarter. Consumer confidence is the strongest in over a decade. Household spending should continue to be supported this year by the boost in real take-home pay from lower food and energy prices. Over the balance of the forecast, wage growth is expected to accelerate as compositional effects fade, and the pickup in productivity supports higher labor compensation. Higher demand, accommodative financial conditions, and emerging capacity constraints should encourage continued investment growth outside of the extraction sector. The MPC expects the global economy to expand at a steady but not spectacular rate, with the principal risks to growth rotating from advanced to emerging economies. The most significant development in recent months has been the increased momentum in our main trading partner, the euro area. European activity should be supported by the ECB's quantitative easing program, which the MPC judges to be net positive for UK growth. ECB action, improvements in euro area fundamentals, and very limited UK exposure all mean that any intensification of the Greek crisis would likely have only a modest downward impact on UK growth. So overall, despite a moderately weaker outlook for demand growth relative to our February inflation report, a similarly weaker outlook for supply means we continue to expect a sufficient firming in inflationary pressures to return inflation to target within 2 years. Beyond that, and conditional on the gently rising path for bank rate implied by market yields, inflation is expected to rise a little above target at the end of the forecast. With the closing of the output gap in sight, the question of the level of the equilibrium interest rate, namely that rate required to keep the economy operating at capacity and inflation at target, that question comes into sharper focus. Perhaps the most important legacies of the financial crisis are the persistent headwinds which continue to weigh on the UK economy, from weaker global demand, sustained fiscal consolidation, ongoing private deleveraging, and with time, higher financial intermediation costs. The MPC has long expected that these headwinds will likely merit not only a more gradual rate of rate increases, or increases in bank rate, than in previous cycles, but also require levels of bank rate to remain below average historical levels for some time to come. There are, however, limits to these effects. At our most recent meeting, the MPC noted that it was uncertain why the yield curve had flattened further over the past year beyond our 3-year forecast horizon. And in this context, the direction of recent moves in advanced economy bond markets are not particularly surprising. Last week, we were all reminded of the difficulties in forecasting the outcomes of complex interactive systems. Today, the MPC is setting out our latest best collective judgment for the outlook for the economy. As illustrated by the fan charts around it and my comments this morning, this forecast is subject to considerable uncertainties and will inevitably be buffeted by domestic and international shocks. That's why the MPC votes frequently. We can respond to events and act to deliver the price stability upon which British households and firms depend. This provides the best environment for the ingenuity and creativity of the British people to flourish and to drive the sustained rise in living standards to which we all aspire. And with that, Manoush and Ben and I will be pleased to take your questions.
As always, can you please say who you are and the organisations you represent? Thank you. Richard and then Larry.
Thank you very much. Governor, the election result was a surprise to everyone. Was it a surprise to the bank? And if it was, how have you adjusted your forecasts for growth in the economy?
Well, Richard, we forecast many things, but we don't forecast political outcomes. We take them as they come, and then we adjust to the consequences of those decisions of the people, whether it's the people of Scotland, the people of the United Kingdom, people of Greece, etc. The most important stance of policy